Have you ever fallen for the myth that your money grows just by sitting in your bank account? It's 3 a.m. and you're proud of yourself because you finally hit 5 figures in savings. You check your balance, feel secure, go back to sleep. Meanwhile, inflation is quietly stealing 4% of that value every single year. Your bank account shows the same number, but your purchasing power is evaporating. Here's what Japanese savers figured out decades ago, that Americans are just starting to learn the expensive way. My name is Kay, and I grew up in Japan watching my parents treat cash in the bank as temporary parking, not permanent storage. I moved to America and discovered people keeping 50,000, 100,000, even more just sitting in checking accounts earning 0.1%, while inflation runs at 4%. That's not saving. That's slowly going broke with a false sense of security. If you want to understand what wealthy people actually do with their money, hit subscribe and drop a like, because what banks aren't telling you could be costing you thousands every year. Here's why this matters. While interest may provide a slight increase in numbers, your money isn't actually growing in value. Take John, for example. He's been keeping his money in the bank because he doesn't understand how money works. He sees his balance go from 50,000 to 51,000 after a year of interest and thinks he's winning. But with inflation at 4%, he needed 52,000 just to maintain the same purchasing power. John didn't gain 1,000, he lost 1,000 in real terms, and the bank isn't explaining this to him. Japanese culture understands something Americans are taught to forget. Cash is not an asset, it's a tool, and leaving tools sitting unused is what we call motenai, wasteful, disrespectful to the resource. My grandmother kept exactly 3 months of expenses in cash. Everything else went into assets that either generated income or appreciated in value, not because she was a financial genius, because she lived through periods when cash became worthless and learned that holding money is different from holding value. Robert Kiyosaki, the financial educator, has a framework that explains this perfectly. He calls it the cash flow quadrant. It divides people into 4 groups: employees who trade time for money, small business owners who work for themselves, big business owners who build systems, and investors who make money work for them. Most people stay stuck on the left side of this quadrant, trading time for money, then parking that money in banks where it slowly loses value. The wealthy move to the right side, where assets generate income whether they're working or not. The key to financial freedom isn't saving harder. It's transitioning from worker to owner and investor. From someone who earns and stores money to someone who deploys money into assets that compound. Let me show you the 4 asset classes wealthy people use instead of keeping cash in banks rotting at 0%. Asset 1. Business ownership. Robert Kiyosaki says the richest people in the world build businesses. Not save money, not work harder, build businesses. Starting your own business or investing in existing ones opens doors to unlimited income potential and long-term financial success. Consider Jeff Bezos, who founded Amazon and became one of the wealthiest individuals globally. He didn't get there by saving his Amazon salary in a checking account, earning nothing. He built equity in a business that multiplied his wealth exponentially. These visionaries don't just achieve personal wealth. They create assets that can be passed to future generations. In Japan, we have a concept of family businesses that span generations. Not because the business itself is special, because business ownership creates compounding value that wages never can. My uncle owned a small manufacturing company, nothing glamorous. But that business generated income, appreciated in value, provided jobs for family members, and when he retired, he sold it for 20 times what he originally invested. Try getting that return from a savings account. Smart Sam recognizes that his skills and time are assets he can leverage through business ownership. He starts a side business, even small, that generates income beyond his day job. Broke Brian keeps his money in the bank thinking it's safe while his purchasing power erodes and his only income source is his salary. In 20 years, Sam owns multiple income streams and appreciating assets. Brian owns a bank account that kept pace with inflation if he's lucky. Business ownership isn't just for entrepreneurs. You can invest in existing businesses through private equity, partnerships, or even buying shares in small local companies. The point is getting your money out of banks and into productive assets that generate returns above inflation. Asset 2. Real estate. Real estate holds a special place in wealth building strategy. Robert Kiyosaki advises learning the art of using debt intelligently to leverage real estate and generate substantial profits. The key is acquiring properties that generate consistent cash flow through rental income. Real estate offers three powerful advantages: appreciation over time, monthly cash flow from tenants, and massive tax benefits that most people don't understand. Look no further than real estate moguls like Donald Trump and Sam Zell, who amassed fortunes through strategic property investments. Let me explain the tax advantage that changes everything: depreciation. Let's say you purchase a rental property for $300,000. The IRS allows you to depreciate that property over 27.5 years. That depreciation can save you up to $11,000 in income taxes per year. So while your property is actually appreciating in value, you're reducing your tax liability. That's legal financial engineering that keeps more money in your pocket. Japanese real estate investors understand leverage differently than Americans. We use debt very conservatively, but we use it. My parents bought their first rental property with a 20% down payment. That property generated monthly income that exceeded the mortgage payment. They essentially used the bank's money to buy an asset that paid for itself and appreciated over 30 years. Try getting that from a savings account. Smart Sam saves $30,000 for a down payment on a rental property, uses leverage to control a $150,000 asset, collects rent that covers the mortgage plus $200 monthly cash flow, gets tax benefits from depreciation, and owns an appreciating asset. Broke Brian keeps $30,000 in the bank earning 4% while inflation runs at 4%. Net result: Brian treads water. Sam builds wealth. Real estate isn't just rental properties, it's REITs, real estate investment trusts that let you own fractional shares of commercial properties. It's house hacking where you live in one unit and rent out others. It's land that appreciates while requiring minimal maintenance. The point is getting your money out of cash and into tangible assets that people need and that generate income. Asset 3. Paper assets. Paper assets encompass stocks, bonds, mutual funds, and other financial instruments. Kiyosaki acknowledges their liquidity and ease of buying and selling. However, he cautions that navigating paper assets requires deep understanding and research. The stock market is where investors like Warren Buffett achieved incredible wealth. But not by gambling, by understanding business fundamentals and investing in companies that generate real profits over decades. Buffett didn't day trade. He bought ownership stakes in great businesses and held them long enough for compound interest to work its magic. Japanese investors approach paper assets conservatively but consistently. We're not trying to get rich quick through stock picking. We're building diversified portfolios of index funds that capture broad market returns over time. My father invested in Japanese index funds for 40 years, never tried to time the market, never panicked during crashes, just kept buying every month. That discipline turned modest contributions into retirement security. Smart Sam invests in low-cost index funds through his Roth IRA and taxable brokerage account. He automates contributions so emotion doesn't interfere. He understands that over 30 years, the stock market has historically returned around 10% annually, which crushes savings account returns and inflation. Broke. Brian keeps his money in the bank because he's waiting for the right time to invest, or because stocks feel risky. In 30 years, Sam's disciplined investing compounds into millions. Brian's bank account barely keeps pace with inflation. The key with paper assets is education. Don't invest in things you don't understand. Start with broad index funds that own hundreds of companies. Learn about dollar cost averaging. Understand that volatility is the price you pay for higher long-term returns. And never invest money you'll need within 5 years because short-term market swings can be brutal. But here's what most people miss. Even a simple index fund returning 8% after inflation will double your money every 9 years. That savings account earning 1% after inflation will take 72 years to double. The math isn't subtle, it's screaming at you. Asset 4. Commodities and precious metals. In times of uncertainty, owning tangible assets like commodities becomes crucial. Gold and silver are prime examples that have maintained value throughout history. Kiyosaki often says, "Gold and silver are money, everything else is credit." These precious metals act as a hedge against inflation and provide stability during economic downturns. Notable investors like John Paulson and George Soros have recognized the value of commodities as means of preserving and growing wealth. Let me give you context. During the 2008 financial crisis, the price of gold was around $850 per ounce in January. By August, it had risen to over $950. As the crisis deepened, gold eventually hit a record high of over $1,900 per ounce in September 2011. This surge was driven by investors seeking safety. When paper assets were collapsing, gold held value. Japanese culture has a long history with precious metals, not as speculation, as insurance. My grandparents kept a small amount of gold as protection against currency devaluation, not their entire portfolio, just enough to preserve some wealth if paper money became worthless. They lived through periods when currency collapsed and learned that tangible assets maintain value when confidence in governments and banks evaporates. Silver offers additional advantages beyond just being a precious metal. It has industrial applications in electronics, solar panels, and medical equipment. This dual role creates consistent demand. You're not just betting on fear, you're owning a commodity that industry needs. Agricultural commodities also matter: wheat, corn, soybeans. Growing populations and changing dietary preferences create demand for these commodities. By investing in agricultural commodities, non-individuals can participate in global food markets while potentially benefiting from price fluctuations driven by supply and demand. Smart Sam allocates 5 to 10% of his portfolio to precious metals and commodities as insurance against catastrophic economic events. He's not betting on gold. He's protecting against the scenario where paper assets collapse. Broke Brian thinks gold is for crazy people and keeps everything in cash and stocks. When the next crisis hits, Brian's entire portfolio is exposed. Sam's diversification protects him. The point isn't to go all in on gold. It's to recognize that different asset classes serve different purposes. Cash for liquidity, stocks for growth, real estate for income and appreciation, commodities for protection. Diversification isn't about playing it safe. It's about surviving long enough to let compound interest work. 5 golden tips to build wealth instead of hoarding cash. Tip 1. Build income-generating assets. Focus on acquiring assets that generate income and appreciate in value over time. Rental properties that produce monthly cash flow. Businesses that generate profits. Dividend stocks that pay you for owning them. The wealthy don't just accumulate money. They deploy money into assets that work while they sleep. Tip 2. Educate yourself financially. Prioritize financial education to make informed decisions and identify opportunities. Spend 30 minutes daily learning about investing, business, real estate, or tax strategy. That education compounds into better decisions, which compound into wealth. Japanese culture normalizes lifelong learning. Americans think education stops after school. That's the wealth gap. Tip 3. Use leverage wisely. Use debt and leverage strategically to amplify returns, but with caution and proper risk management. Borrowing to buy appreciating assets makes sense. Borrowing to buy depreciating consumer goods is financial suicide. Learn the difference. Tip 4. Surround yourself with like-minded individuals. Network with people who share your wealth-building mindset and can provide valuable insights. If everyone at your table is complaining about money, find a new table. If everyone at your table is building businesses and investing, you'll naturally elevate. Tip 5. Embrace failure and learn. See failures and mistakes as learning opportunities to grow and improve your financial knowledge. Every successful investor has made mistakes. The difference is they learned from them instead of letting fear paralyze them into keeping cash in banks earning nothing. Here's the truth that hurts. Keeping large amounts of cash in the bank feels safe. It's not. It's the slow, comfortable slide into being broke. Your account balance might stay the same, but your purchasing power erodes every single year. That's not safety. That's the illusion of safety while you're actually losing wealth. Smart Sam keeps 3 to 6 months of expenses in a high-yield savings account as an emergency fund. Everything else gets deployed into the 4 asset classes we discussed: business ownership, real estate, paper assets, commodities. He's diversified. He's generating income. He's protected against inflation. He's building wealth. Broke Brian keeps everything in the bank because it feels safe, and he doesn't understand investing. He thinks saving is enough. In 30 years, Sam has multiple income streams, appreciating assets, and financial freedom. Brian has a bank account that barely kept pace with inflation and wonders why he worked so hard for so little. The difference isn't luck. It's understanding that cash is a tool, not a destination. It's recognizing that banks benefit from your ignorance. They pay you 1% on savings while lending that same money at 5%. They're making money on your money while you think you're being safe. Japanese savers figured this out after watching our currency nearly collapse post-war. We learned that cash holdings are temporary and that real wealth comes from owning productive assets. America is learning this lesson right now as inflation reveals that keeping cash in banks is not the safe move people think it is. You have a choice. Keep doing what feels safe and watch inflation slowly steal your purchasing power. Or educate yourself, deploy capital into assets that generate returns above inflation, and build actual wealth instead of the illusion of wealth. The wealthy aren't keeping hundreds of thousands in checking accounts. They're using banks as temporary parking while they deploy capital into businesses, real estate, stocks, and hard assets. They understand that money is meant to work, not sit idle. Subscribe if you want to learn how to think like an investor instead of a saver. Like this video if it changed how you see your bank account, and take action this week, not next month, this week. Open a brokerage account, research your first rental property, start that side business, buy your first ounce of silver. What asset class are you going to start with? Drop it in the comments, and remember, the riskiest move right now is thinking that keeping cash in the bank is safe. It's not safe, it's expensive. Choose differently.